Good morning, Your Excellencies, ladies and gentlemen, colleagues and friends. It's an honor for me to be with you again this morning to discuss a topic which is not an easy one because it affects our continent in a very deep and serious way. But our industry, insurance and reinsurance, I can assure you it has shown resilience in the past and strength to bounce back even within this situation. I will try to make it simple because the first key note speaker has really discussed the issue of debt and how it works on macroeconomic level. So it is very easy for me. I will be using analogies to make sure that we understand these complexities of macroeconomics and how it affects our industry. So I will cover the state of the play, how Africa looks briefly, and how the sovereign debt transmits itself into our operations, our strength, our solvency, and as well our growth. And later we'll use a case study of some of the economies which have gone through this situation, namely Ghana, Argentina, Greece, and Zambia. And after we discuss the currency risks, because it is one of the risks which we are facing, especially those who are reporting in US dollars as some reinsurers on the continent. And we'll close by some general remarks and recommendations. So there are some key definitions. Public debt, as you know, government borrows, it has been mentioned, to fund infrastructure, to fund agricultural dams, to fund airports, and so on, hoping that it will get some tax revenues and payback. And debt sustainability, it's when your neighbor comes and borrow, but you doubt if he's going to pay because he didn't get the growth necessary to repay you, or he didn't collect the revenue to pay you, or where he invested the money borrowed, I think the projects were not completed. As you know, in Africa, we have that serious issue as well. It's not that all the loans which were given to Africa were used at the best. We know some of the projects which are abandoned or which were diverted and so on. So we can't only blame the low growth coming from external shocks, whether it is the Ukraine war, whether it is the COVID and so on. Some are also some of our mistakes. And sovereign default is when your neighbor comes and say, I can't pay you, I'm bankrupt. That's all. So it is acceptable to say that you can't pay, and everyone will get what they call a haircut, whether insurers have invested in bonds or in other instruments, and the government says, I'm not paying you, that's all, you will not get your money back. And debt trapped, it's your neighbor or your brother, and you keep giving him money until now he's borrowing you to repay you. And he's borrowing you at a higher interest rate. So it becomes unsustainable. That is unsustainability. And there is a series of connections which happen in the economy, especially with the sovereign exposure. When a government defaults, the first in the line in the front line are banks, because you know banks they collect, they mobilize resources, and they fund the government. So they are the one to lose. The example of Ghana, for example, many banks, regional banks, including Africa Re and others, lost a lot of money, up to 37, I think, thereby. Not only African, but also foreigners who invested in the Eurobonds and so on. So that is it. The banks will have problems, and this will come to also the corporates who have invested in the sovereign debt instrument, and this tripled. So it is estimated that 51% of chances that the sovereign crisis can occur anytime from now, not only from Africa, but there are many other governments which are under stress, but those governments are more resilient, and they have more resources, and they have more diversification compared to our government in Africa, where you find that where our income is coming from one commodity, for example, or another, and that is difficult to navigate. But also, this nexus, this interconnection between sovereign banks and corporate can also come from the banks. You remember when AIG was considered as a systemic risk, and it triggered the 2008 financial crisis. Now, how do we look? Quickly, Africa has borrowed a lot since the years 2010s. You remember the Lions on the Move, Africa Rising around 2010, 2013. It was true, but it has increased the borrowings, and we are now at 1.1 trillion for a GDP of 2.8 trillion. That is almost 40% in average, but country by country, some countries are already at 70%, and others are going there. So the sovereign debt sustainability of Africa is a serious matter. So 72% of GDP. It's like your salary. Most of us here, we live on salary. It's like your salary, 72% is used to pay debt. So you are remaining with 28 to cover your operations, and probably you cannot invest anymore in education, healthcare, and others. So it becomes a deadlock situation, and there must be some intervention from the government, also some intervention from the international community, because sometimes you can't do it alone anymore, and you will go to knock to the doors of IMF, and they will start to tell you what to do. And what to do, it's never very, very easy because of other social and economic pressures in our countries. Now, the sovereign ratings have been downgraded in many countries, and this may continue if the debt crisis is not seriously taken into account and resolved at the global stage. Everyone is waiting for the G20 meeting in South Africa this year to see if that international financial architecture can be re-engineered so that there could be some funding to support economic growth of Africa. And as you know, Africa, we boast to have the biggest youth population, but that youth population, if it's not productive, it is useless. It can't buy insurance for us insurers. If someone who is 20 years or 25 years is not employed, so he's not buying insurance, so we can't say that we are going to grow if our economies are not growing. And it is a bit sad that when we have the youth today, in which we should invest in education so that they become, we become the industrialized nations like Asia did, so it can be a lost generation. That's a big risk. It can be a lost generation because it will not be integrated in the global economy. You have heard about all the divide, the gaps in terms of knowledge of AI and so on. And this is a major risk. I think that leaders on the political side are going to do something. Now, the sovereign debt ranking. Some countries are at high risk of distress. Others are already in distress. Others are moderate. But I may say that almost all the countries, if you take out maybe few of them, like 10, 15, or others can also fall into the trap easily because of the triggers which are pending, like the high interest rate. So if you can't borrow because the interest rate is higher than what your project will generate, so you stop borrowing. Otherwise, you are going into that debt trap. And aid cuts with the Donald Trump administration. Some countries are facing also a cut in their budget with the lowest contribution from the US, unproductive youth, climate risk, and global financial system shocks, which, as you know, recession is always coming back every time, and there is a certain percentage of recession globally, and this may happen, and you understand what will happen to Africa. Sometimes we say that we have also minerals, but those minerals, we don't fix the price of those minerals. Some of the minerals, sometimes you can have them, and it is less to mine. I mean, it's not productive sometimes to mine and sell, because you'll be selling at loss. So you can have minerals, but since we don't add value on minerals to create products which have a high value and attract more investment on the continent and be less dependent on imports, this becomes a serious challenge. So now the sovereign debt and insurance sector. So specifically the insurance sector also has its own interconnection with the sovereign debt when it happens. You know that insurers invest in their cash in government instruments, which in most of our countries, it is the biggest employer, the biggest spender, and the biggest generator of projects. So, and we lend to the government, and the government cannot pay or reschedule its payment. In some countries in Africa, you may check, you will find that the government sometimes doesn't even disclose how much they owe to providers of services and goods in their country. And you have heard the story of Senegal, that the new government found out there are a lot of things which were not declared, and the government is almost under pressure to disclose all the debts they have. So, and this will trickle down completely to what we see, for example, inflation and claims and currency depreciation and counterparty contagion where we have invested and so on. So it goes around, it's a loop, and we are also systematically impacted, not like banks, but it is a reality, and this has been shown in Ghana, Zambia, because of the haircut I've mentioned, AIG when it has to be bailed out in 2009, Argentina and Greece. So specifically, an example of Kenya, based on regulatory report, in 2023, the Kenyan insurance had up to 70% of its assets exposed to government security. So this is high, and in other countries, similarly, so the portfolio mix may change from time to time, depending on the regulation, depending on the opportunities, depending on the interest rate which the government pays. So in Ghana, up to 42, in Uganda, up to 66, and so on. These averages indicate the risk we have in case there is a sovereign debt or any distress or restructuring of those securities we have with the government and so on. Now, insurers have a certain sensitivity in different countries. They come to be seen in different ways, which are mentioned here. So in some countries, the sensitivity is very high because of the dependency to government investment securities, and also to all what we have mentioned, including economic growth, including counterparty contagion, and so on and so forth. So we are vulnerable to sovereign debt risk across selected African countries. And this is probably going to worsen until we see the light, as we see in a case study that some governments like Egypt, Ethiopia, Nigeria have done a lot of effort to restructure, to improve the macroeconomic environment, and now things are getting better, stabilizing, and capable of attracting again investment and also stabilizing the inflation, but also more importantly, regaining growth as well. So the consequences of country debt on insurers are, one, on the investment side, and the interest rate volatility, the regulatory pressures, and also macroeconomic fallout. We always think about macroeconomic fallout because of low growth, but we have, in our data in Africa we have found that the GDP of Africa is not correlated to our insurance industry, mainly because of the low penetration in some countries. So we have a huge room to grow, a huge potential to continue growing in the coming decades. It's almost endless, as the Deputy Prime Minister has mentioned. The youth, the middle class coming, the agriculture, modernization, and so on and so forth. So we have plenty of opportunities to grow. But when this comes, so investment and valuation of our assets may be impacted, especially by the interest rate. As you know, interest rates impact the valuation of your asset and so on. Now, this chart is very interesting. If you look at South Africa, 60% of GDP is represented of annual GDP by insurance assets. And in Egypt, it's 2%. In Morocco, it's 20%. In France, that figure is 120%. 120% of insurance assets, insurance assets are higher than the GDP of 1 year, 120. And the average of Africa, if you remove South Africa, we are around 1%. So you understand that we are not contributing as insurers to resource mobilization, which may help government to stop borrowing from outside, including in forex, in hard currency, which we can't generate and so on. You know that a government which if we correct premium income in local currencies, and those premium incomes are given to the government, there are many things we can do on the continent. Let's say agriculture. Agriculture requires what? Salaries to pay to our people in the rural area, to cultivate, to stop irrigation, to stop deterioration of our soil, and all those things in the rural area where we pay in our local currency. So a lot of things can be done by our government if we could provide them with that. So this is a call really to say that we are almost meaningless in some countries as African insurers because we contribute very low in terms of funding our economies. So it is time to take this message. We have tried our best. Recently in Abidjan during the Africa CEO Forum, we had a side event and proposed some solution to unlock the role of insurance on the continent. Now, a case study, as you know, some countries are in pre-sovereign default. The economy was booming and so on was good, but the level of the debt to GDP continues to go up for different reasons. It could be some political issues, it could be some instability, it could be some miscalculation as well, it could be external shocks, especially external shocks for the countries we have mentioned. When the Ukraine crisis started, you remember how African countries suddenly started to import at a very high cost, and they were not prepared to that, and so on. So then you go into sovereign default. When you go into sovereign default, it becomes serious because you can't raise any more debt because people they are fear that they are going to lose, and also a lot of them are waiting to be restructured. In the debts we have mentioned, The debts of China are not mentioned because China is not a member of the Paris Club. So a lot of debts which they have given to some of our governments are not known, the size, the quantum, and also the vulnerability. So that is another issue. But the post-sovereign default, it's when a country now starts to restructure, and there have been some losses. Of course, some insurers have lost money, and so on. So this is a case study. This is Ghana. I didn't want to mention, to just put a country there, but this is Ghana. You will see that the real annual GDP was going down, but now it has started to go up as they have tried to reduce all those weaknesses, including the currency. Currency is improving, and the debt to GDP, which reached even 80% sometimes, is starting to come down, which is very good. And also, the public debt is reducing, so which means it's now a restart. And for those who are very tactical and agile, this is the time to go in the market and benefit from that growth and that stability, which is key to attract foreign direct investment. I overheard, I think, one of the interview of the current president of Ghana saying that there are up to 2.9 billion projects which are blocked in the country, whether it is infrastructure, healthcare, and others. So they will start soon to borrow once they have stabilized. And this is applicable to Zambia, to Nigeria, to Egypt, and so on. And apparently, the Egyptian market now, because their currency is now really very cheap, it's very good to invest in Egypt today, as the real interest rate is positive again. So the currency risk, it's another phenomenon which affects insurers on the continent, especially those who have trans-border operations and reinsurers like Africa Re. So there are accounting exposure through translation. Any money you have in an economy and you report in US dollars, every year you have to revalue it. If it is less in US dollars, that is an FX loss. And there are also transactions and other operations. Also, you are affected in many ways. We are going to show you an example. So we have three reinsurers, Africa Re, Zepri, and Waika Re, reporting in US dollars. But most of other insurers, they report in their own local currency, so they may not see this phenomenon only in inflation, as we have mentioned. So for those reporting in USD, and especially Africa Re as an example, in terms of top line, Africa Re recorded $1.2 billion of premium income in 2024, and this would have been $5 billion if we use the exchange rate of 2012. So we'd be a $5 billion company. And it would have been $2.3 billion if we used the exchange rate of 2017, or 1.8 if we use 2020. So you understand how top line is depleted by those accounting standard, especially when you report in US dollars. But specifically in terms of profit and loss and the other comprehensive income, this is where the shareholders feel now the impact. And the shareholders can be any investor. For example, if Africa Re want to raise capital, if it was not profitable, Africa Re is profitable, but if it was not profitable because of this phenomenon, no one will invest in your company, especially when he comes from outside and invests in US dollars, is waiting to get his fund back. So you'll see in 2024, Africa Re recorded $61 million of loss, FX loss, 19 in other comprehensive income. This is the revaluation of all the assets, monetary assets, and 41 million in profit and loss in terms of transactions, claims, profit, and so on. So it is a serious matter for insurers. And however, there are risk management mechanisms you can put in place to protect yourself. Number one is to track that risk. that risk of sovereign debt, that risk of currency risk, you have to have a strong department in risk management, which is following, doing the stress tests and looking at what you can do. You can do the natural hedging. In some countries, you can buy gold. I don't know if many countries are allowed to buy gold, but apparently in Egypt, you are allowed to buy gold and keep it in bank. And there are other ways of hedging as well. Investment in property. Property is a hedge against inflation, against currency, but of course, regulators will stop you to invest everything in property because property is not liquid. So, but it's one of the ways you can do. You can improve your terms and conditions to make sure that payment delays are penalized by an inflation and by an interest and so on penalty, and so on. So, of course, you can write more businesses in US dollars if they are present in your market, or if you're allowed to invest outside. Like in South Africa, insurers are allowed to invest 25% of their assets in US dollars denominated securities, and sometimes even outside. So this is something you have to discuss with the regulators to see how to improve the resilience of insurance companies which are facing these risks. So I have 3 minutes to go. So as closing, I would say that there are many ways to protect yourself. We are a live example as Africa Re in terms of portfolio diversification. When we started to grow outside the continent, it was in view of what is going to happen. So you have to time the cycles. Everything has a cycle in life. We know our market cycle in insurance, in reinsurance, but even our countries have a cycle. Because you borrow. If there is no macroeconomic discipline, you know that one time there will be a kind of a reset. And that reset, there are losses. So you have to time them and monitor them. So there are many ways of doing risk management. As you know, regulators, sometimes they also force us to do that. We have to engage regulators and the flexibility in investment. We have to innovate in terms of product, and also, where possible, to have government guarantee when there will be restructuring, that investment from insurance companies may not, in some of the project, may not be affected. And however, this has found to be very difficult when you are discussing with the IMF, because they can impose you what to do sometimes against your will, as you have read in the news, the dispute between Afrexim Bank and Ghana about the preferred creditor status, where Afrexim Bank is saying, I should not have a haircut, I should not be restructured, I should be preferred against other lenders, and the IMF is telling Ghana, no, Afrexim Bank is a normal lender like anyone, like any private, no preferred treatment. So in terms of takeaway, so sovereign debt is a critical risk factor. It affects us in many ways, especially when our countries have deteriorated sovereign credit ratings, high and volatile inflation, and also large proportion of mandatory or voluntary domestic sovereign bond in our assets. But there is a need to reinforce our risk management at individual level, but also at industry level, to always track that risk, how it is, and what we can do to mitigate it. And there are techniques, as you know, like the ORSA, on risk and solvency assessment, which in advanced industry, every insurer, every board of an insurance company and reinsurance company, they have to assess this and report how they see themselves in terms of solvency margin, in terms of future, in terms of capitalization, and so on. So with that, I thank you very much.